Hello everyone, welcome to my today's video. Today we are going to solve a practice question, how to uh, make balance sheet transactions and how an transaction can affect the balance sheet items. So let's move to the real problem. So it says like Alfa Romeo incurs direct cash cost of $30,000 in manufacturing a red convertible automobile during 2016. Assume that it incurs all of this cost in cash. Indicate the effects of the following events on the balance sheet in 2016. So we all know that balance sheet has three major components, and we know the equation like assets equals to liabilities plus owner's equity. And further we divide shareholders equity in three other parts like contributed capital, which is commonly include common stock, and accumulated other comprehensive income, and retained earnings, which is basically the includes the income and expenses. So we have to figure out how this event impact on each item of this balance sheet. So you can see in the example, Alfa Romeo, they spent $30,000 on a automobile. So what happened here? Like you purchase an inventory because you are a automobile company and you purchase inventory to make it a finished product and you will sell it in future. But right now you paid cash 30,000, so there is a decrease in cash. So we will subtract $30,000 from the cash account, right? So what happened on the other side? So you have one inventory as your asset, right? You have now convertible automobile. So 30,000 we add back with automobile inventory. So we can see here this event only impact on the asset sides, right? And we know that the equation should be equal. So in one account we have positive $30,000 and in the same account we have negative $30,000. So this makes it equal in the transaction, right? All right. Next, let's continue with additional problem. Now, say Alfa Romeo, they sell this automobile now for $45,000 and they get instant 5,000 cash, and remaining they make an agreement to make it in annual payment. So let's take the cash transaction first. So see, they get 5,000 cash, so we add back to the cash account 5,000, and the remaining amount is due. So it is basically accounts receivable, or you can also say note receivable if it is in a formal agreement. So this outstanding balance is also an asset for Alfa Romeo. So we put 40,000 on notes receivable and 5,000 for cash. So this becomes 45,000 on my asset side. So what happened to my automobile? Now I sell it to other party, right? So this sales is 45,000. It increase your revenue because this automobile is your inventory. So when you sell your inventory, this is basically your sales. So we add back sales to return earning and we subtract automobile inventory from the asset because you have no more assets with you. So we subtract 30,000 from automobile inventory, and you have incurred some cost on that automobile which was 30,000. If you look at our previous slide, there's 30,000 you have already incurred cash. So this is your cost of goods sold. This is the expense for that inventory, so we deduct it from the return earning. In the next part we include some interest payment like 4% for that remaining outstanding balance. That's our notes receivable, right? So the amount was 14,414, which is the total amount. But if we consider the interest rate, like out of 40,000, the 4% is 1,600, and if we deduct it from the annual payment, we can get the principal payment. So in the balance sheet transaction, what we do, we, like, as we get the full payment in cash, so we will increase the cash by 14,000, but the notes receivable, we will decrease only the principal portion of that amount. So after deducting the interest payment from the total payment, we will get the principal component 12,814. And as interest is a revenue, we will add back it to the retained earning. I hope it helps you all. If you have any questions regarding this or regarding this concept, feel free to reach me, ISL15228@ttu.edu. Thank you all.